I'll explain why high inflation means interest rates must rise this year. Secondly, what's pushing inflation up. And finally, why Australian interest rates will probably sit at around 1% by the end of the year. Let's dive in. Around the world, central banks share the same primary goal of keeping inflation in check. They mainly do this using interest rates as their tool. This is because high inflation destabilizes the economy by eating away at your purchasing power, how much you can buy with your given income. Now, across the globe, we are seeing high inflation rates, and this inflation wave has come to Australia too. Annual inflation is sitting around 5% at the moment, up from 3.5% the previous year, the highest it's been in 20 years when the GST was introduced. There are three key factors driving inflation up. Firstly, lower unemployment. The unemployment rate sits at 4%, the lowest it has been since 1974. Secondly, supply shortages, particularly construction supply shortages and oil shortages due to wars. Thirdly, excess demand. This is because government stimulus packages being offered are adding fire to inflation. However, at the same time, there are two factors restraining the central bank from raising rates too much. One, higher level of household debt. A 2.5% cash rate by the end of the year means $1,300 more each month on $1 million loan, or an extra $800 each month on a $600,000 loan. 2. Central banks are hesitant to get in the way of wage growth. So what can we expect? Interest rates will probably rise to around 1% by the end of the year in order to curb inflation. It would make sense to raise interest rates gradually now rather than waiting till inflation hits 10% and then trying a huge rate increase to compensate. Thank you so much for watching. Now if you liked the video, please hit the like button, and if you want to see more videos, please subscribe. And if you have any video topic that you want me to cover, please let me know and I'll seriously consider doing it. Thank you.